What's up, guys? Welcome back to the channel. I'm Ty as usual, and this is Stock Muscle. So today I don't have a stock recommendation for you, but I really wanted to talk to you about investing versus speculating. There's a new class of investor that's crowding the market, and I'm seeing some pretty bad habits. Let's talk about it, guys. Okay, so once again, welcome back to the channel. So today's topic is investing versus speculating. As I told you guys in some of my older videos, I am a former broker, so I've bought and sold equities for high net worth clients as a living before. I've done it as a profession. And what I'm noticing is there's a new class of investors out there, and you see a lot of stuff going on the outlets like Reddit and StockTwits, and I'm seeing some really bad behaviors. I got into an argument on StockTwits with a gentleman, and we were arguing about a biotech company and their cash burn and their high issuance of shares. And he just wasn't willing to take in any of the information. I wasn't, trying to dissuade him from buying the company. I was just telling him, hey, look out for these things. But, I got a total disdain and disregard. And man, it really scared me because, as an investor myself, you want to help people avoid catastrophic losses if they can. So let's get into it. What is investing? So the reason that we buy stocks is because there's several things that you could do with your money. A, you could spend it all and not get any return on it, right? B, you could put your money in a bank, but banks don't really pay anything. So in return for supreme safety, the bank's not going to pay you much money on your on holding your money. So it's low risk, but it's low reward. Stocks promise you that if you're willing to take a risk and if you're willing to buy good companies, you should be able to achieve a decent return on your money. So for example, if you just bought the S&P 500 every year, you bought the index that mirrored the S&P 500, you should be able to make about 6 or 7% per year. So for you risking your money, you should be able to see a pretty reasonable return in equities. And that in a nutshell is the reason why we buy stocks. But there's a way to kind of mitigate your risk because stocks are called risk assets. They're inherently very risky. So what you can do to mitigate that risk and lower that risk is you can make sure that you're buying good companies. We went over in my other videos what good companies look like. Good companies bring in revenue. They convert that revenue to net income and profit and earnings per share. They have good cash positions, and they're able to grow well over a long period of time. More speculative stocks don't do that. They may bring in revenue. None of it may trickle down to the income column. They may have no cash position. They may have a good product, and you think that product is going to sell well in the future, but we call that hope and hot air. A lot of the times the valuations will get really high. The company hasn't done anything to deserve that valuation. Then it starts to trade on hope and hot air. We're basically buying the stock because we think that in the future, this company could do great. Sometime that works out well, but most of the time it doesn't end well. And this is what I'm seeing a lot of the times in the stock market. Companies like GameStop and AMC, those are a little bit of an exception to me because those are short squeezes. And I think, quite frankly, that the Reddit guys, the apes who are inducing those short squeezes, I think they were pretty smart to kind of point out what was going on there and capitalize on it. It's a capitalist society. That's what we do. So I'm not mad at those guys at all. I get those plays. But other companies like these sketchy biotech companies that all say, oh, we have the next wonder drug, we have the next product, haven't even gotten through FDA approval yet. They haven't begun selling the product yet. It's just all hope and hot air. So I want to pose this to you guys. I want to create a scenario. So let's say that I own a private equity company, Hamilton Investments. You're the new private equity guy in the office. You just got hired. Hot shot, 21-year-old, 22-year-old, fresh out of college. And I give you an assignment. Your assignment is we as a private equity company, we're looking to acquire an auto manufacturer. You have to go out and acquire that auto manufacturer, report back to me and tell me which one that you think we should buy. That's the assignment. So let's look at that. Let's look at a couple of auto manufacturers. Let's see if we can identify which one is the best investment and which one is the most speculative. So let's dig into it. So when we open up the chart, let's take a look at three of the most prominent auto manufacturers in the country. So we're going to take a look at Tesla. We're going to take a look at Nissan. And we're also going to take a look at Toyota. So I've created this chart on Y Charts, and like I told you guys, I'm thinking about creating an account with Y Charts. I really love how you can put together these really cool charts. But nonetheless, let's get back to it. So me as a young executive, I've narrowed it down to these three companies. This is what it would cost for me to buy these three companies. The blue line represents Tesla. This is in billions. So to buy Tesla, if you look to the far right, it says I would have to pay $609 billion to buy the entire company. That's what we as a private equity firm would need to pay. It also says that for Toyota, which is in the orange, $181 billion to buy Toyota. So a lot less than Tesla. Nissan, it would cost us about $5 billion to acquire the Nissan Motor Corporation. I'm a big GTR fan too, so if I would probably buy Nissan just off the strength of the GTR and the Z. But nonetheless, Tesla's the most expensive investment. You would think that with that being the case, Tesla makes the most money and brings in the most revenue. But let's take a step further and see if that's the truth. So in trying to acquire one of these companies, of course, I'm going to go for the one that brings in the most money and makes the most revenue. So let's see which one that is. The orange is Toyota. Toyota makes, and this isn't quarterly. Y Charts wouldn't give me yearly for some reason, but nonetheless, this would ring true yearly as well. So last quarter, Toyota brought in about $72 billion in revenue. Really good. Nissan is revenue, $21 billion in revenue. It's not showing the current quarter. I'm guessing that they didn't report yet, but as of their last reported quarter, they're at $21 billion in revenue. Tesla, which is the most expensive company, has only done $10 billion in revenue. That's strange. Okay, so let's go to the next thing. It's not about what you make, it's about what you keep. So who's actually doing well in the net income column? Toyota's done, in the orange, once again, Toyota's done $7.3 billion in net income. So they kept $7 billion of their revenue as profit. Nissan, of course, they're negative at this point. They're not. That's a big worry sign. They're operating in the red. They're reporting negative net income, so they're not keeping any of their money. As a matter of fact, they burned almost $400 million. Big negative. Tesla was able to keep about $400 million, which is an incredibly small amount when you compare it to their revenue. So if we were to choose a winner, which one would you guys choose? I'm really curious. Leave it in the comments. Personally, I would be looking to acquire the Toyota Motor Company. But let's look at this again. Let's go back to what it would take to buy the company out. So knowing that Tesla comes in at number 2 in net income, they're the most expensive. They're at $500 billion to buy Tesla. Toyota would only cost me $181 billion. So me, as a young executive, I'm going to go back to my boss. I'm going to say, boss, I'm going to recommend Tesla. Here are my reasons. The revenue's really good with the company. The net income's really good with the company. They've been public for several years. This is the one to go with. If the boss says, well, why didn't you go with Tesla? I would tell him, quite frankly, that Tesla's trading on a lot of hope and hot air. It is the most expensive of the three, but they do less revenue than all three of the companies. They're beating Nissan in net income, but the point of the matter is Tesla is a prime example of a company that is overvalued and that trades on hope and hot air. The reason you would be investing in Tesla is because you think that at some point they're going to outsell a company like Toyota. They're going to outsell a company like Nissan. But at $500 billion, Tesla would almost need to outsell every major car brand. Now, I didn't mean to make this a Tesla experiment, but I wanted you to notice the difference between investing and speculating. The speculator would buy Tesla. They would buy Tesla. They would make a big bet on the future sales, and they would go that direction. The investor would probably go with Toyota. Now, I'm not saying either one is right, either one is wrong. I would consider myself the investor. I would go with the safe bet. But, a lot of people would probably go with Tesla. So that's what I wanted to talk to you guys about today. I just want to do that quick experiment to show you guys what it looks like. And I'll probably do a part 2, 3, and 4 to this video, and we'll go into it deeper. But remember that investing is about putting your money into good companies. A lot of the times, these small biotech companies that I was arguing over, how can they promise a return to you when they haven't even made a return for themselves? A lot of times they bring in revenue, and when you look at the net income column, it's negative several hundreds of millions of dollars. That's called burning cash. The company's not profitable. How can you promise me a reasonable return when you've never achieved one for yourself? If you have made money in these companies, then it's like hitting the lottery. You hit a home run. But what happens when you step to the plate and you try to hit a home run every single time? You're probably going to strike out a lot. And that's what we don't want to do. We want to practice the sweet science of investing. We want to practice the art of hitting and not getting hit back. And the way you do that is making sure that you're putting your money into good companies that have a long track record of making money. So that's all I got for you guys today, guys. Leave a comment. If you like the content, hit the subscribe button. And remember, it's all about, companies that make money. This is Stock Muscle. I'm Ty. I'll holler at you guys later. Thanks for dropping in.